The US government is shut down. We won't be getting any data for quite a while, it seems. Gold is rallying, silver is catching up. What is happening in the world? It's really, really interesting, and I've invited a fantastic guest on the show, Matthew Piepenburg. He's a partner over at Frankfurt Gold, and we're going to chat about all these factors. What's the impact of the government shutdown in the US? The Fed won't be getting any data anytime soon, it seems, to make the next rate decision here at the end of October. And then I also want to discuss with him the US dollar. The Swiss National Bank just recently announced that they're not buying any more dollars, they're buying euros, and they already own more euros than US dollars. It's an interesting trend that sort of aligns with the trend that we're seeing from the gold buyers. Gold is now more important for a Fed as a reserve than the US dollar as well. It seems there's a trend. Let's discuss. Before I switch over, though, hit that like and subscribe button. It helps us out tremendously, and we much, much appreciate it. Now, thanks. Matthew, thank you so much for joining us. It's always great to see you. Thanks for making the time.
Of course, Kai. It really is always a pleasure talking with you. Glad to be here.
Yeah, really looking forward to catching up. Maybe we'll start, at the beginning with the government shutdown. It's an interesting story. We're in day 2 as we're recording this. Nobody really knows how long it's going to last. Of course, it's Democrats versus Republicans. They don't seem to be finding any common ground. If you listen to the Democrats, they don't want to budge at all. Of course, the blame game is being played here. But what is your assessment? What do you think is the effect on markets?
Well, like I used to joke, you could drop a nuclear bomb in Cleveland, it wouldn't affect the markets as long as rates are low and the Fed is supporting it. In terms of politics in the U.S., I mean, certainly anyone familiar with the U.S. who's lived there or living there now, we're both pretty familiar, but obviously spent more time in Europe. But look, it's an incredibly polarizing time. I don't want to be too reductionist, but this type of extreme left-right debates is nothing new. It's just the degree of it's becoming worse because the degree of desperation is becoming worse. The narratives are becoming less trustworthy. There's a lot of strings to pull on, but at 30,000 feet, I'd say polarization, partisan polarization is the problem, or the symptom. The problem is we're in a debt corner, a debt trap. We've talked ad nauseum about the statistics, the data. I won't get into that now. The obvious unsustainable, unhaltbar debt in the U.S. And the desperate type of measures to fix it and the desperate types of lies to hide it, which we can get into. But in my opinion, I can reduce things to debt. That affects politics. It affects the culture comp, the struggle socially, the polarization socially. It affects the policies from the Fed to tariffs, to stablecoin, to the US dollar. So all of these things are tied together. I think at the base of this is a debt crisis that's becoming a debt trap, which is becoming extreme. And so even if the plumbing is complex in the COMEX, or the plumbing is complex at the Fed or the Treasury or yield curves or rate moves or dollar discussions, citizens definitely feel angry. They feel the purchasing power hurting them. They feel inflation as it's not reported in real terms. They certainly feel it in their daily lives. And they're angry and they're looking for reasons and they're looking for blame, whether that's at the social level, the political level, and of course at the partisan level at the House and the Senate. It's an absolute mess. It's more so than ever before, but we're used to that in the US. The degree of it's just gotten worse. And again, we can pull on different strings, but I do say it's coming down. We call the fourth turning, the great taking, the cycles of history, but it's coming down to a crisis that we can no longer hide. Even the 60-20-20 portfolio at Morgan Stanley, where whales are admitting we need to buy or we need to hold U.S. gold, that's not even coming from the top down, that's coming from the bottom up. Clients, high net worth clients, are actually undeniably seeing the rise of gold. They're undeniably seeing that for 20 years, Wall Street has been poo-pooing gold as a pawn shop asset. It's too volatile when it's outperformed even this S&P bubble for a quarter of a century. So you can't hide what gold is doing in price moves. If you look a little deeper, you can't hide why gold is rising, because trust in fiat money in general and trust in the world reserve currency, weaponized, debased, over-indebted, is now becoming obvious. It's felt by everyone as becoming more obvious to investors, even to Wall Street banks, and frankly, even to politicians. Even Besant, I don't have a lot of respect for his honesty, but it's certainly more honest than Yellen that we have a debt crisis. Trump certainly knows we're in a debt crisis. He's got all these policies, USAID, Doge, stablecoin, tariffs, gold revaluation, all these things to save us. None of them will, because we're past the Rubicon. But long answer, short question, a lot of polarization, a lot of frustration, a lot of infighting. I personally think it's coming from the financial effect of feeling stressed from Main Street to Wall Street. and certainly in DC. And I think that stress emanates from the ripple effect of a debt crisis that is now a debt trap.
Absolutely, yeah. No winners here. U.S. politicians in blame game over shutdown is the Financial Times headline. Sort of exactly what I just said without knowing exactly what I was knowing the headline here, obviously.
Right.
But my point is, like, you brought up Doge, and before you mentioned it, I had actually written it down as well. 'Cause President Trump has been, I don't know, I want to use the word threatening, but he's been mentioning, like, well, this is an opportunity for layoffs on the government side as well. Let's call the herd. Terrible term to use here, but do you see any effect coming from that shutdown? Is there anything more than that, than besides the polarization on both sides of the aisle here? Is there a chance? Like, I'm always grasping at straws here and glimmers of hope, but is there a chance to turn things around on the budget side potentially?
I mean, look, you can pink slip 75% of the bureaucracy in DC, which is a bureaucracy. It almost makes the Soviet bureaucracy of old look tame. I mean, there's no doubt there's a lot of fat and waste in DC. Then again, 75% pink slips create a lot of unhappy citizens of DC and in the agency class, so to speak. These kind of bureaucrats on Route 66 and Route 60, used to see them every day when I lived in Virginia. A lot of them really have nothing to do. That will upset some of them listening, but we know that there can be cutting some spending there. But again, that kind of savings and spending at the Doge level, you could get also by just cutting rates by 25 basis points. That gives you billions of new dollars that you could spend just by having rate cuts. So Trump has been he's been trying to do both: cut the fat at Doge, cut the fat at the bureaucracy, and get rate cuts. But again, I'm not saying it's the end of the dollar or the end of America or even the end of the world reserve currency, which we'll get into, the dollar. But there's no doubt that the dollar, its respect, its hegemony is in open decline. There's no doubt that there's a reason central banks hold more gold now, first time since 1996, than they hold U.S. Treasuries. There's no doubt that de-dollarization is more than a headline. There's no doubt that the BIS making gold a tier 1 asset next to the U.S. 10-year has a reason. So all these things, from Morgan Stanley to the BIS, to the man on the street, to Wall Street, the dollar is under reinvestigation review because it's debased, and debasement comes from debt. So this is nothing new. And spending cuts to cut spending to try and help our deficit, to try and help our debt problem, is a Band-Aid solution to an open chest wound. It's not going to be enough. And it's not even partisan anymore, because left or right, it doesn't matter. And I've said this smugly. It doesn't matter who's in the White House, doesn't matter what party, it doesn't matter if it's Santa Claus or Papa Smurf. There is no easy solution. There is no quick solution without some constructive destruction, some austerity, more currency debasement, further desperation. Of course, gold's only rising because dollars, like all fiat money, are becoming less and less effective. And that's not an argument for the gold bug school, the kooks. It's an argument of history. It's an argument of basic math. We know this. We've tried a lot of desperate attempts. You got to give credit to Trump. You can say he did a heck of a lot more than the last administration. You could say a headless chicken from Doge, USAID, tariffs, etc. It's too little too late. We've crossed the Rubicon when you get to 120% debt to GDP, and you get these 37 trillion debt levels. You get these trade deficits. You want the world to buy your U.S. treasuries. At the same time, you're tariffing them. At the same time, you're trying to get trades, with Robert Triffin, you're going to have a trade deficit if you've got a strong currency, if it's the world reserve currency. So blaming that on the rest of the world is a failed policy. Punishing the rest of the world is a failed policy, and expecting them to buy your IOUs when you're weaponizing that IOU and when you're so in debt at historically unprecedented levels. The world's catching on. Banks are catching on. Citizens are catching on. Politicians are, of course, never taking any accountability. And the Fed and the Treasury and the White House are fighting. So it's a bunch of children trying to blame each other when the bathroom mirror would do for any of them, because all of them are to blame and they're all responsible. It's been generations before them who are to blame. So we're at a turning point, and the degree of which we can talk about with the dollar, of course.
It feels like we're at the tip of a triangle. So like what's the technical term, at the tip of a flag, whether it's bull or bear. We need to figure that one out, because it feels more bearish than anything else. But it feels like something is about to give here, and we're very close. Maybe allow me one follow-up before we get to the U.S. dollar in more detail here. Is really the Fed funds rate. What is your stance on it? Like, should it be higher? Should it be lower? You've been hinting at the government obviously wants lower rates to get more financial flexibility. But what is your stance? What should the Fed do if it was truly independent?
Look, if it was truly a fiduciary, if it was truly a strict parent, if it was truly there to do what's right in the long term, 10, 15, 20 years out for our country, as Thomas Hernig warned, if it was really a fiduciary to the nation, as opposed to the rich uncle to Wall Street, which is really what it is, and a truly dependent part, it's the fourth branch of government. It's just not officially so. I mean, I've joked it's the Federal Reserve, but it's not federal. It's not a reserve. It's on constitutional lab. And it's not even constitutional. So it's done a fantastic job of manipulating its way into something official when it's actually an independent private bank, which has completely distorted price discovery in the markets and has completely spoiled Wall Street and completely ruined fiscal common sense for every administration since it came into being. Certainly since Nixon decoupled from the gold, every member of the White House, red or blue, has come in and spent beyond his means because they always knew the Fed was there to monetize whatever debt with an unchaperoned fiat currency. So the Fed will not do the right thing. It never has. It's only benefited the Wall Street class, my class, and we can spend hours on that. But to your point, did they do the right thing? Of course not. They did the simplest thing, the fastest thing, the easiest thing, because the Fed looks 2 or 3 months ahead. It doesn't look 2 or 3 decades ahead, as Tom McCormick said they should. And he was one of the few Fed, FOMC presidents who actually vetoed everything Bernanke and Yellen were trying to do because it was such short-term, quick fix dopamine rush for the markets and for their quote-unquote thermostat attack on inflation and employment. But look, at these debt levels, what can the Fed do? When you're looking at 37 trillion bar tab from Uncle Sam, you can't really raise rates because they tried that in 2022 and 2023. It just was a disaster. They never did beat inflation. The bond market wouldn't let them. The debt market wouldn't let them. Trump couldn't beat or prosecute a tariff war because the bond market wouldn't let him. In April, Liberation Day, what caused 10 trillion in market loss wasn't Trump's tariffs. It was the bond market, the Treasury auctions going silent the next day, yields spiking. When yields spike, that scares the hell out of the government because that means the cost of debt spikes, their bar tab spikes. So even though Trump is calling Powell a loser and an idiot and a moron in tweets or X, whatever you call them nowadays, the simple fact is Powell's under a lot of political pressure. He's caved to the fact that we can't have higher rates with debt levels this high. And of course, he'll use the dependent employment data, which was horrible, to justify lower rates. What the Fed should be doing and should have been doing a long time ago is recognizing that we have a debased currency. We have a stock bubble from low rates for decades. We have a massive wealth inequality. We have a loss of confidence in our Treasury. We should be raising rates, but they can't afford to raise rates. And they're in this trap where the world wants higher yields to have an interest in these US Treasuries. So you need higher yields or higher rates to get those interests. But at the same time, 13 trillion international debt is dollar denominated. So higher rates makes the world have to pay higher bills. So they're damned if they do, damned if they don't with the world. Internally, America can't afford higher rates. And so they brought down rates using the data dependence of unemployment problems or labor fears. But really, they're surrendering. They're admitting that our war on transitory inflation, first transitory inflation was another lie, like the recession. We've lost that war. We've given up on that war. We now have an inflationary policy. We're having a low rate policy. Technically, that means a weaker dollar in most cases. And so they should have raised rates to try and slow down the speed of the bubble, to try and restrain deficit spending, to try and get us into a much stabler debt and deficit spending policy. But no politician, left or right, can control themselves from deficit spending. So they need lower rates. It's a short-term dopamine rush. Long-term, it just means more currency debasement, more asset bubble inflation. There's benefits the top 10% and hurts the bottom 90% with inflation. It's nothing new, nothing surprising. And Powell tried this again. He tried to reload his guns. He tried in 2018 with QT and rate hikes. Then there was a December panic. Then there was a 2019 pause. And then by 2020, there was QE to the moon. He tried higher for longer from March of 22 to June of 23. That didn't last, caused the worst nominal returns of stocks and bonds since 1870s. He has no room to move. So it's now the tools are getting less and less powerful. Rates are coming down. The balance sheet will soon get fatter. And we'll be right back to currency debasement 101, inflate your way out of debt, negative real rates, which we won't report honestly because we won't give the honest number of inflation, and we'll screw the middle class as we've done throughout history. It's just nothing new.
Matthew, I could chat with you for hours. Just questions pop in my head just constantly. And one is like, should the Fed more focus on inflation or unemployment? Maybe as the last question here on the Fed and their policies.
Well, the real, if you actually look back to 1913, you look at the documents of the Congress, you look at the Federal Reserve Act, they say they have two mandates, employment and inflation. Their real mandate is the bond market. Their real mandate is Wall Street. They are a creature of Jekyll Island, but they are a father of cartel bankers. That's from Europe and the US, and it's a very select type of mentality. It's like a gang, really. It's like a mafia. And I know that sounds exaggerated, but again, if you look under the hood, this is not a shocking surprise. Their real mandate is to keep the cost of debt lower and to keep the bond market legitimate, because they don't want those yields to spike. That means debt too expensive. That makes leverage harder. That makes the bubbles harder. That makes markets lower. That makes their bonuses smaller and banks less profitable. That's my very cynical view. You can argue that all day long. I don't think it's a fiduciary. I think it's an insider trade. And I think the Fed isn't really data dependent. Hell, even Powell admitted that the employment data they got completely wrong last year. But he says our data isn't that reliable. Even our forecasts aren't that reliable. He literally said that. Well, then what is it? Are you stupid or are you lying? Because you're supposed to be a data dependent body. What their real mandate will always be is monetizing the debt market. Now, with some sympathy for the devil, Powell in particular, I spent a lot of time criticizing Powell, but even Thomas Schernick would admit, if the Congress or the Senate and the White House are going to consistently spend beyond their means and then look to the Fed to bail them out with mouse click money, is that entirely the Fed's fault? No, you could blame that on the politicians, but it's a vicious circle, because politicians know the Fed is there, and the Fed has always been there to bail out the markets, to keep rates low when necessary, to create market bubbles, to create debt that's affordable, so that we can live on the temporary prosperity of debt, what Hemingway called, but they're ignoring the permanent ruin of currency debasement and war, which Hemingway also warned, and which many economists have warned for centuries. We're basically living on the short-term high of low rates for 4 decades. We're now paying the piper, and the victims of that aren't the Wall Street and the 90% the top 10% who got 90% of the inflation in the stock market, because they own those stocks before QE 1, 2, 3, 4, and infinite QE. So that top 10%, as the Cantillon effect warned in the 18th century, inflation is not opportunity blind. It's very class sensitive. It benefits the early money first, which is Wall Street and the banks, and it screws the middle class with the debasement of the currency and the misreported inflation. And that's what's happening right now. And it's very sad. And no, they've done the wrong thing, and they're going to debase the currency. They're going to inflate their way out of this debt with negative real rates. They're going to lie about the inflation. And if inflation is, as John Williams and everyone knows on Wall Street, closer to 10%, nowhere on the yield curve are you beating inflation. Every bond you own is losing money. And effectively, it's a defaulting bond. And the Main Street economy doesn't understand the complexity of the Fed or of the yield curve or rates or negative real rates, understandably so. It's meant to be complex. And they look around feeling poor. They don't quite know why. They blame each other. They get into all these identity politics, but the real cause is financial. And it starts with our central banks and our politicians who spend and then monetize that spending with money created out of nowhere, and then pretend that inflation isn't real. It's an absolute fiction. It's an absolute crime. It's drunken, criminally negligent driving at monetary policy. But this is, again, neither red nor blue, Trump nor Harris nor Biden nor Bush nor Clinton. They've all done it. Reagan, the great hero, did it. So it's an insider game. I wrote about this in 2019. It's rigged to fail, and it's failing now.
Maybe another sign of that is, let's discuss that. Let me bring that up on screen. I saw an interesting article just today, actually. It's a commentary on Reuters, and I think it fits that thematic perfectly. It's just the sign of the times is Swiss buy euros, not dollars. And that also fits the theme, and let me bring that graphic up here real quick as well, is that the US dollar has that gold has surpassed US Treasuries as a form for foreign holdings, which is another interesting trend. So I want to touch with you on that. De-dollarization. How strong is that trend? I remember last year that was the buzzword, bar none. It's quieted down. I'm not sure if the media got an email to quiet down about the de-dollarization, but it disappeared from headlines, I'll tell you that. So I'm curious, but looking at this here, the trend is intact.
Well, it's a lot of the fascinating things. I mean, certainly, yes, this is the first time since '96 that central banks hold more gold than U.S. Treasuries. That's a massive sign, a lot of reasons. The trend really began all the way back in 2014 when central banks were net sellers of treasuries and net buyers of gold. Now the gold has surpassed the treasuries in actual holdings. This process of kind of moving away from this slowly over-indebted U.S. Treasury, which was in line because QE2 was starting around that time. The world was saying, boy, this country's in a lot of debt. They're printing a lot of money. They're issuing a lot of debt, a lot of IOUs. The eyebrows were raised as far back as 11 years ago. Obviously, 2014 is when the data really started to come in. Certainly by 2022, which I said, and many others, not just me, said that was the seminal moment in my life watching the macros when we weaponized the US dollar against a major nuclear power in the R in the BRICS, already in bed with China, which is the C in the BRICS. When we weaponized the dollar, we also constructively defaulted on a bond there, but we weaponized an already indebted dollar. And that's when distrust for the U.S. Treasury accelerated at a higher pace, when gold stacking by central banks tripled overnight. And for the next, since 2022, gold has been stacked at an incredible historical rate. Again, and around that time, the BIS came in and gave gold a tier 1 status. And then we saw these problems on the COMEX. But this distrust of the Treasury comes from two places. A, there's too much debt. They don't trust the issuer. It's just becoming too desperate. And B, they weaponized that in 2022. Again, regardless of what you think of Putin or Zelensky in that rabbit hole, it was, as Robert Triffin warned in the 1960s, the biggest mistake you could do with a neutral reserve asset. If the U.S. Treasury becomes a non-neutral asset, a weaponized asset, the world will go to a neutral asset with no counterparty risk, and that's physical gold. That's why we're seeing the stacking by central banks. That's why we're seeing the BIS give it credit. And that's why we see the COMEX seeing this panic and the LBMA banks seeing this panic, and why we see SPYMEX in St. Petersburg and the Shanghai Exchange getting more credibility, because the world is, as predicted, moving to a more trusted strategic reserve asset and moving away from this U.S. Treasury. And of course, that has an impact on the dollar. But we did this to ourselves. We went too far in debt, and we weaponized that so-called neutral reserve asset, and the world's responding. And de-dollarization, which you said everyone's trying to ignore or downplay, as just something that would take years and years. And we could talk about the dollar in more detail. It's actually happening much faster than even I thought. But I knew that 2022 was as big a turning point for the dollar as 1971. And I've got the receipts. And again, I'm not alone. We all saw this who were tracking gold and tracking the collision of politics, monetary policy, and gold. And it wasn't a gold bug case. It was just understanding history.
Yeah, absolutely. Let's take a look at the DXY together maybe as well. Mm-hmm. Let's take a look. Let me take silver out of here of this chart. Add it here. There we go. And we do this. Nope, we got to remove this, and then we add this. There you go. Too many buttons, too many things. But let's look at the DXY here over the last, 5-6 years here, or 7 years in this chart, and especially this year-to-date performance. I know year-to-date is a bit unfair because it's very short-term if you in the overall scheme of things, of course. It seems to be bottoming out here a little bit. What do you make of the DXY in comparison to other currencies, the dollar in comparison to other currencies here?
Yeah, let's just start by, let me be very clear. I'm not saying this is the end of the dollar. The dollar goes to zero. The world reserve currency ends tomorrow. The yuan or the ruble comes in, and the world lives happily ever after. And we need to talk about this. I've had many conversations, many of them interviews that have been published on YouTube with Brent Johnson years back about the dollar, and the DXY, and just recently in South Africa with Heinrich Sieber. Very smart guys who have a very strong thesis. I'm not even saying they're wrong. I want to set it up so that we know that there is a strong dollar camp out there. Ultimately, all of them are pro-gold. I think of Brent Johnson. He's very eloquent. He's very smart. He's not necessarily wrong. And it's the same thing with Heinrich Sieber. He has a very similar argument to Brent. So I want to give credit due, and I'll simplify their argument. It's not a stupid argument. I'm not saying I told you so or that I'm right. I will say that when I had that first conversation with Brent a few years back, I think the DXY was at 109. Now it's in the 97 range. Does that mean I won the milkshake debate? Not at all. It just means that for the last few years, the DXY has gone where I thought it would for the reasons we can get into. What Brent Johnson and Heinrich are both, I think, saying is, yeah, de-dollarization is real. Yes, debt is real. Yes, the dollar is a real beast. It's a real mean, weaponized, unfair currency, and there's a lot of reasons to hate it. But there are things you can't deny about the dollar. And these are kind of the core. And again, I'm simplifying, so I'm sure Brent is rolling his eyes. But it is true that 58% of global FX reserves are in US dollars. That 80% of global trade finance is in US dollars. There's 13 trillion in global debt that's denominated in US dollars. There's 90 trillion in FX swaps that are traded. There's this massive euro dollar market, the derivative market. They're all demanding dollars. It's like the euro dollar, it's like a $10 trillion market. It's like, I think my buddy Alistair McLeod calls it the Hotel California. You can check in anytime, but you can never leave. There's all these, dollars going out and they're staying there. They're not going to be repatriated back. They're tied up in derivatives. In other words, there's this great big straw sucking demand for US dollars. Love it or hate it, it's part of the world currency. It's part of the system the world's relied on. It ain't going anywhere soon. And it's going to always be strong. And what they're also saying, and what Henrik Zeberg is saying clearly with a strong argument, again, all of them ultimately pro-gold. But what Henrik is saying is there's going to be mean reversion in this overinflated market at some point very soon, in his opinion. When markets crash in 2026, they're going to be a lot like 2008, where there's going to be one last rush back to the lifeboat of the US dollar and the US Treasury, because there's relatively nothing better to go to. And so we'll see a massive retracement in the gold price and a spike in the DXY. And that's the argument for the strong dollar. I will give a different argument, but as you've already heard, I think the dollar is so distrusted, unloved, and weaponized now that the game has changed significantly, and that the signs we're seeing right now in the DXY, in the gold market, in the COMEX, with stablecoin as a desperate attempt, in the Doge spending cuts, all these things to save the dollar are too little too late. But what I will say to Heinrich and Brent's theory is it's very plausible theory. And it is possible that in another market mean reversion, the dollar becomes the safe haven, the US Treasury becomes the safe haven. It's arguably plausible that that could happen. What I'm saying is very different in 2008, and this is this conversation from 2008. What's very different in 2025, and Francis Hunt and I kind of double team poor Heinrich in this conversation, is it's not the same world. What's happened between 2008 and 2025, first in US debt level, it's gone up exponentially. What's also happened is the weaponization of the dollar. What's also happened is we pushed the BRICS in the East too far. When we weaponized that dollar, that was kind of the last straw in trusting this neutral reserve currency. In the meantime, the countries of the East, the central banks of the East, even pre-weaponization, even pre-2022, have been playing what I call chess, while the West and the US play checkers. They have been silently stacking their gold internally, unreporting that gold to the World Gold Council. They've seen the longer arc of history, the longer direction of the hockey puck for years. It was hard to talk about this when the DXY was strong and gold was getting pressed down and the COMEX was suppressing the price. No one wanted to believe this. It seemed like kooky theories. But I think these things are now playing out, especially post 2022, at a rapid pace. The BRICS, the de-dollarization, the rise of the SPYMEX in St. Petersburg, the rise of the Shanghai Gold Exchange, now letting foreigners come in, they don't have to be Chinese entities, getting freer price discovery, with the outflows in the COMEX too, in the silver and gold space, the ability to artificially short those metals is significantly different today than it was in 2008. You've got, again, 3x expansion in the central bank, gold purchases, the tier 1 status at the BIS. It said all these things to me make me less hopeful that Heinrich and Brent are going to be right about the DXY spiking to 130, 140 for a lot of reasons. Most importantly, I don't think the US could allow the DXY to spike to 130 or 140. There would be an immediate yield curve control, an immediate currency debasement, not years or months later, but immediate. But what we all agree, yeah,
the trade
so many things. I don't see it. Does that mean I'm right? No. I'm just giving a different argument. I want to give respect to their argument, and I'm simplifying their argument. But they're basing that, in some sense, the dollar's too big to fail for now. And eventually it will weaken, but not before one last dance, as Heinrich calls it, the last dance. I think their dance card's already been punched. I could be wrong. Either way, Brent, Heinrich, myself, Francis, and many others, Jim Rickert, we all agree on one thing. Whether you think there's not enough dollars or too many dollars, the gold is going to rise in this market secularly, directionally, because fiat money has, as it does throughout history, as it does from Trippen's dilemma, as it does from all the things that we learned from David Hume to Gresham's law to Richard Carlton. The dollar is just going to melt like an ice cube and have less purchasing power, just like the euro, just like all the paper money. And so we're all pro gold at the end. The debate on the dollar is still open. I think there's a credit cycle clearly ending, and the dollar is just credit. So there's a dollar cycle ending. I think the fact that Judy Shelton rightfully wants to have a gold-backed bond, and that many say that's going to happen, whether it happens or not, it's already an admission of guilt. It means we need a gold-backed long end on the Treasury, gold-backed Treasury, because our dollar and fiat-backed Treasury is no longer trusted. It's just that simple. Central banks are telling us right now they'd rather have gold than U.S. Treasuries. The U.S. is saying we need a gold-backed bond. It's literally saying the quiet part out loud, that gold is trusted more than our IOUs and our greenback. So, look.
Here, let me bring that graphic back. That's exactly the point. Let me bring this back, and we got to end on that note as well. But we're right on that. That's exactly it. So gold is more trusted than any toilet paper, for lack of a better term. So I had a prop prepared as well. We'll get to that next time here. I was just going to show it real quick, but it was stable coins will preserve the dollar's dominance, says Trump Jr. So that's another topic for debate for next time, Matthew.
That would have been fun.
Fantastic. Matthew, what a wonderful conversation. I love chatting with you. As I said, we could chat for hours. I tremendously appreciate your insights. Where can we send our audience to follow more of your work?
Yeah, Von Greyerz obviously is vongreyerz.gold or vg.gold. Von Greyerz is hard for a lot of people to spell. And so vg.gold or goldswitzerland.com is still our URL too. And all our articles, interviews, videos, thoughts, you can debate them all day long, but they're there. Decades of them are there to be read. And you can find us there. Yep.
Awesome. Matthew, really appreciate your time. It's always great to catch up. Looking forward to seeing you in November in Zurich. I hear we're having dinner together.
Wait, it'll be great. Yeah,
I hear we're having dinner, so I'm looking forward to that. Thanks so much, and everybody else. Thank you so much for tuning in. Really insightful conversation with Matthew Piepenburg. He's a wealth of knowledge. Always appreciate his insights. Go check out Gold von Greyerz.gold or vg.gold. Visible gold, eh? That's what that stands for as well. Not too bad. Well played. Yeah. And also, let us know down below. Maybe we can discuss the stablecoin debate here a bit more in the future with our next guests. Definitely talk about whether stablecoins will save the U.S. dollar, because that doesn't bode well for gold, theoretically. So thank you so much for tuning in. We'll be back with lots more. Take care out there.